Welcome to the week that was. We're covering December 16 to... No, we're not.
No, we're not. I just noticed that myself. That was what we were talking about.
That's next week.
I know. I duplicated this week's edition, right? I warned you. I'm not very good at IT.
8 to 13.
Just let me stick to Cape. Right? Just let me stick to Cape. And it's not 8 to 13. It's 9 to 13, isn't it?
It doesn't matter what it is. We're going to talk bullshit anyway.
Okay.
All right. For whichever. So.
Let's do that.
The market's expensive. See you next week.
There you go. Okay. Just saved you 37 minutes of listening to me rabbit on.
Well, this is post-Christmas now, so Merry Christmas. Hope you had a good... Yeah, this would be post-Christmas, 27th, I think. So hopefully Santa came and had a...
Oh, it is too,
yeah.
Okay.
Hopefully had a good little break. But
Hopefully we're all still alive, and the Cape should be probably 40 by when we're talking about. Anyway, this is the big statement that came out on December the 5th. The world economy has exited the boom and bust cycle, BlackRock says. Just a warning to folks that you can, if you go and type that sort of stuff in Google, you'll get it at 2000, 2006, 2007. So my point being, what happens every time is, what was it, 1929, the week before the crash, Irving Fisher came out and said, we've reached a permanently new high plateau. So in other words, what he was saying was, this is it.
Keeps going.
It just keeps going. And of course, what happens? The stock market hits the Great Depression.
Yeah.
Now, the interesting thing about that is too, in the 20s, we talked about this a couple of weeks ago with the boom in debt, right? Because everyone was buying white goods and cars and stuff, right? So, but again, the boom in debt, right? And that's what you got going on in the US, right? There's margin debt. Everybody's borrowing and piling up.
The fact that they can even say that, so December 5th, 2024, they're saying there's no more cycle. It's just, it goes up forever. Based on what? Based on what? Like, all you got to do is
shut up and buy stocks. You idiot.
Someone sat there, woke up one morning and going, fuck yeah. There's no cycles
There's no
anymore.
more cycles anymore. Prices just go up.
It's a straight line.
But that's what I mean. Like I said to you last week, Bitcoin's going to be worth 13 million. It's like, oh, please stop it. That's ridiculous. And they had that with Elon Musk. Elon's company is going to be worth, like, I don't know, what was it? Robo-taxis were going to be worth like 15 trillion. And it's like, well, hang on, the world economy is only 100 trillion. Yeah. Like, I think we're getting a bit carried away, folks.
And then they're like, oh, well, it's going to be multi-universal off-world.
Yeah.
So what? It's uncapped.
It's Elon Musk, I went back and had a look at it during the week. Elon Musk in 2014 said we'd have self-driving cars in 2015.
Right.
Next year is the 10-year anniversary of not having self-driving cars. Right? And that's why I say to you, now people are going, we're going to have robots and AI, and it's, we're all going to have robot servants and, blah, blah, blah. It's like, all right, okay, all right. That's funny. That's what they said in 2000. We were not going to have any retail stores because everyone would buy online.
Oh, they said it in the 80s when Rocky 2 came out or whatever.
Yeah. I know. That's what I mean. Everybody gets carried away.
Yeah.
Crazy.
Price to book ratio of the S&P. So like similar story to what we've been talking about, but it's through the roof.
5 times
book.
Best of luck.
Yeah.
Dance close to the door, folks.
Just look somewhere else.
It's hard to, though, Jacob, when everybody's making easy money just buying US stocks.
Yeah.
Right? And there was something I saw yesterday. Oh, what was it about the Magnificent Seven? It was a tweet I kept.
Something about 70% of, is it that one?
Yeah.
70% of market cap or something.
Keep talking while I
on that point, so the amount of messages that I'm getting personally, and even on the TMM social saying, teach me about crypto and Bitcoin, and I'm going back saying, why didn't you message us 2 years ago or 18 months ago? And they're like, oh, well, because the price...
Bitcoin wasn't up.
Because the price
was... Well, in 2022, mate, it went, as I said last week, it went from 67 to 17 or something.
And I'm like, well, you wanted me to show you how to make all this money, which I can do, but it's not going to be like if you're expecting it to go from 100 to 200,000 in the next 6 months, it's probably not going to work that way.
But it could do, or it may not.
But when it comes back down to 50, are you going to be messaging me saying, teach me?
Yep.
But no, because you're in this irrational exuberance, like, fuck, I feel like I've missed out.
Yep.
So like, okay, if you come to us now, we'll teach you how to do it, but it might not work tomorrow.
I found that tweet.
Okay.
Right.
Good.
The tweet is from Interactive Brokers CEO, right? The trading platform, right? The Magnificent Seven represent over 70% of the trading volumes on the platform, right? Now, he then also came out and said this. Now, excuse me, this statement was deleted, right, after he said it. So over the last 3 months, this is the CEO, right, Thomas Petterfly. Over the last 3 months, our margin loans are up by 16%. Hello. Jeez. And which is rather it's a bit, open brackets, very something, close brackets, if you ask me, because I think that equity prices are somewhat overextended.
Mm-hmm. This is the CEO of the Interactive Brokers.
Right? Somewhat overextended. Not, that's code for holy mother of God.
Yeah.
Right?
I've got a board to impress.
And I hope, and I hope that as they come down, quote, they will not come down too fast, right? So we can liquidate as it happens, and we will not end up with holding the bag from people who are unable to meet their margin calls.
Oh, that's going to be catastrophic. Well,
here's the head of a company, the world's largest trading platform, right? And he's saying, you know what that's code for? Holy shit.
Yeah, get out. Maybe take some off.
And margin loan, to get a margin loan now, I think the rate is about 10 or 11%.
Yeah. Well, this is the issue, right? These platforms, like Interactive Brokers is amazing, right? We use it.
Yeah, it's great.
But if it collapses, they've got the cash. Like, you can't get the cash back.
Well, that's why I think he's saying, gee, I hope it declines slowly, because every notch downward triggers a new round of margin calls.
Yeah.
And so that's where you get, you get the consistent selling down, because the margin, like you get momentum on the upside.
Sell,
you
sell,
get it.
sell.
You get it on the downside.
Yeah,
right?
And that's forced selling as well. Margin call, you're done. See you later.
Absolutely.
No more money.
You've got to raise the capital.
Yeah.
And how do you do that? Well, you've got to sell the stocks.
Yeah. And if you don't have any more capital to put in, it just triggers.
Yeah. It just gets uglier and uglier.
Yeah.
Righto, Tuesday, Reserve Bank held rates again.
4.2, what 4.25 they held at, or 4.35?
Unchanged at 4.35.
Yeah.
And the big issue there was on Tuesday when they said that, which was sort of expected. They got roundly bagged again because, the economy's doing terrible, right? Yeah. And they're talking about inflation and all this sort of stuff. But then, of course, and a lot of economists, my favourite friends, came out again and went, inflation's under control. And right, so we get the employment figures on Thursday. Unemployment's fallen from 4.2 to 3.9. So in other words, no, unemployment's not rising, so they can cut rates. In fact, unemployment's falling. They would have to be going, maybe the economy's going too strong.
Yeah.
Which, as I said, I find completely stupid when the economic, the US is growing at 3.3% real.
Mm.
So put on inflation with about 2.5%, so it's growing at around 5.5% to 6%. That's fantastic, right? Australia, we're growing at about 0.8%. So in other words, we're in a recession without all the immigrants flooding in.
Mm.
And they're talking about holding rates at 4.35.
Yeah, they'll hold them until probably February, where then it might come down.
Yeah, I doubt it's going to. Well, the only thing that's going to make it fall is some catastrophic event, like it happened in the GFC, right, where they have to emergency cut, where Kevin Rudd said, righto, we have to, you guys cut rates and we'll throw a bucket load of money at the electorate.
Yeah, but I mean that might happen.
Absolutely.
Yeah.
Well, what else are they going to do? Stand by and watch people, sell out. This is again the problem with property, right? If you've got a lot of debt, well, if unemployment starts rising, that means someone's losing their job.
Yes.
And if you've got a mortgage and you're losing your job and the economy's getting worse, not better, that's when you start going, I might be in a spot of bother here.
Yeah, and then that happens across 100,000,
Yep.
300,000 people.
Yep.
It's I think 2025 is going to be, for all countries, is going to be an interesting year because it's dependent on what Trump does a lot of it.
Absolutely. And and it's expensive. If the Cape was 10 or 12 or even 20, I'd be saying, okay, well, let's not panic too much. But we're talking about all the valuation indicators being at in the 95 to 99th percentile, right? Then when you look at these ones, right, which is investor sentiment. See, I look at it in two ways and say, is it expensive? Yes. Okay, well, it might be justified. But when you look at investor behaviour, all these people are buying shit coins, they're all trading options, they're all buying the Magnificent Seven, they're all doing crazy batshit things, that's when you go, okay, this is a bit nutty.
Yeah.
Right? And this one is, the cost to hedge a portfolio with 1 month S&P options, this is put options, has only been lower during 2 short periods in the last 30 years. So in other words, people who buy put options now are getting it really unbelievably cheap.
Yeah.
Now, the reason why is because 60% of Americans think the stock market's going to go gangbusters next year.
So for people that don't know what put options are, this is expecting the US market to come down.
Yeah, what you do is instead of saying I want the market to go up, you buy a put option, right, which says the market's at 6,000, right, the S&P. And let me declare, I went short the US market last week at 5,000, right? So what I'm saying is, look, over the next 12 months, if the US market falls from 6,000 and it goes to 5,500, people will say, oh my God, I'm going to buy Steve's option because he's got it at 5, right? So therefore my option, if it was $1, it might be worth $2.50.
Yep.
Right? Now, it may get to the end of next year and go,
it's at 7.
It's at 7, you lose all your money, which is fine. You just don't go batshit crazy on buying a lot of put options. Yeah. But my point being, what this is saying is nobody wants to buy put options because the market's just going to continue upwards.
Yeah.
And it's like, okay.
Well, this is exactly what someone like Buffett says in the reverse, where it's like buy when there's blood in the streets.
Yeah.
This is saying buy when there's everything's golden.
Yep.
Sell when everything's golden.
This is what's going on, right? Yeah. That's what I mean. When you look at it and say it's only ever been cheaper for 2 short periods during the last 30 years.
So it's what, here, 2008?
Right? Yep.
And 2000...
About 17 or 18. So that's what I mean. You've just... That's what I mean. It's just crazy, right? Nobody wants to short the market because they think it will continue rising. And as I said, it may well do. It may well do.
Yes. And what's the other one? BBUS as well.
Yeah, well, that's
negatively geared.
Yeah, BBUS is a leveraged ETF on it's the inverse of GGUS.
Yeah.
Right? So everybody wants GGUS.
Yep.
Right? Because it's leveraged up and that's margin loans. Everybody's on that front, right?
Yep.
Leveraged ETFs are like going absolutely gangbusters. I think there was 145 billion put in last week or something. So in other words, this is why I'm saying you need to be really careful, right? Because everybody's punch drunk and it's just getting crazy. And you can see it particularly among young men and Bitcoin and anything that's got this, options, right? 0-day options. You just buy them and they go through the roof. And you hear stories of, the young guy who bought the banana, right, as a piece of art, right? That sort of stuff. Everybody of that age is boasting how rich they are, right? That's I can tell you, that's what happened in the internet, right? That's what you see in Australian property. Billy the pizza driver, now he's got 15 properties, which is get fucked to you people who didn't get in, right? Yeah. All you got to do is work hard and, blah, blah, blah. So, okay. And that's what I mean. I've seen it all before,
Yes.
Oh, sorry.
I don't know what to go.
I don't know how many times I can just keep saying this, right? There you go. There's the Cape, 39. Next.
Well, no, it's interesting. I know we've talked about it a lot, but the next 10, so the Cape at where it is right now
Yep.
is projecting over the next 10 years that we might get a 2 to 3% return.
Well, the way you work it out is the Cape is, 39, let's say 40, right? Okay, 100 divided by 40,
Yep.
right? 2.5, something like that, right? That's what Cape says you'll get.
Yep.
Now, that's without inflation.
Exactly. That's my point, right?
So now that means zero.
You're at 0
Then-
or minus.
Yes. And then you've got to pay fees,
Yep.
right? And that's what I'm saying. If you went into the stock market now and said, "Oh, Steve, I've got 100 grand. I want to buy the US stock market. What should I expect to get?" I would say, well, if you went to a desert island and came back 10 years later, you're probably going to be losing money, right? So in 2000 to 2010, you lost about 5% annual average per year. In other words, you lost 50%,
Yep.
right? 65, this period here to 82, around there, same deal. You just lost it over a longer term,
Yes.
right? 29 down to 32, same
Crashed.
deal. Okay. You only have to look at that chart and go, man, that's really high.
It's only been higher once, which is in the .com.
Yeah, but when
44 or
you
something.
calculate for modern stuff and inflation and stuff, it's actually higher than 44.
Right. Okay.
Well, it's higher than the .com.
Yeah.
Right, and that's what I'm saying. This is really nosebleed territory where you're really playing with fire,
Yeah.
right?
Which is why we're. Well, not
Which is why I'm saying you
not
need.
advice, but
Well, no,
we're
you
in
just-
options.
Look, you know, if you want to go out there and have a shot, by all means.
It's
but
a short-term strategy you got to apply.
yeah, you just really want to have your eyes open and not putting your money in anywhere for the long term because the yield is awful. Right? I read this morning where the yield on cash is now more than the earnings yield of the S&P. Right? And what I'm trying to point out there is cash is safe. The earnings yield of the S&P, if the S&P goes down 50%, you're going to lose an absolute bucket load of dough.
Yeah.
That's when you're going to go, man, I wish I'd have stayed in cash. But staying in cash is hard when the market's,
When everyone's making money.
Well, and everyone's going, buy this, buy that, buy this. You just buy the Mag 7. You buy this, you buy this, you buy Bitcoin. You just buy houses, blah, blah, blah. Everyone's gone crazy.
Yeah, it's wild. Before we jump into Friday, a couple of questions. I'll go with one question here
Yep.
from Tom on Instagram. So for those who have sold down and for someone like Steve who has put his money in cash, what would the ideal time look like to reinvest into the market? So everyone, it's this like what next question. What would an ideal situation be to say, yep, let's back in? And we speak a lot about strategy. I have recently sold down, but I'm struggling to conceptualize the part of my plan to get back to reinvesting. So it's basically we're a bit scared. We're in cash.
Yep.
What's
what do we
next?
do?
Yeah.
Okay. Couple of things there. One is I'm not in cash,
Yep.
but most of the portfolio in terms of weighting is in well one, which is a short-term strategy. So I'm not going to bore you with that. But essentially what you're doing is when the market's rising, you adjust your allocation, right? Until it at the moment well 2 has done quite well this year, but it's not, I haven't got a lot of money in there because the US Cape is 39.
Yeah.
Now I know Brazil's 10, I get it, but Brazil could go to 5. Right? If the US crashes, they're not going to go, oh, let's all rush to Brazil. It'll go down, right? So there's that issue. Okay, when do I get back in the market? Okay, this is where valuation is important, right? Because, again, if you look at the 2000 to 2003 period or the 2007 to 2009 or 29 to 32 or 65, blah, blah, blah. If you look at those periods, what you find is when a Cape at 39, let's say the Cape falls to 30. Okay, so it's gone from 40 to 30. Okay, so that's 25% decline. Man, it is time to get back into stocks. Well, is it? The Cape's at 30 still.
No.
Right? And so that's what I'm saying. You have to look at the valuation. Apple falls from a PE of 40 to a PE of 30. Oh, man, let's get in. Well, it's still double the long-term average, right? So you have to be, and I think we talked about this last week, where we're saying, well, you have to look elsewhere and say, hey, maybe I should buy a property in, somewhere where it's cheap. Now, I'm not recommending that because property's expensive itself, but you got to look at the yield, okay? And that's really, really important. Any investment, if I said to you, oh, look, Jacob, just leave your money there, you'll be fine. What should I get, Steve, over 10 years? And I went, oh, you'll probably lose, I don't know, 5% per year. You'd go, what, are you, an idiot?
Yeah, why would I do that?
But that's why, because I'm talking about the yield, right? And so that's the same if you bought a property and you said, oh, Steve, how much can I expect to make? And I went, well, rental, you'll probably not make anything because of inflation and, you'll make nothing there. And look, capital gain, well, I don't know. You may not make anything either. In fact, you may lose money because, you're buying it at 8-9 times income and the long-term average is 5. Yeah. Well, again, you'd go, well, that's not a very good investment. And it's like, I know. That's because I'm looking at the yield, right? This is the problem, Jacob. Everybody's looking at that capital gain.
And short-term capital gain as well, not even long-term capital gain.
And that's why I say, take your cue from one of the greatest investors the world has ever seen. When he's got a lot of cash, and look, I know he's mega wealthy and blah, 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 but he still compounds his capital at the high level by buying and selling, right? Buying when it's cheap and selling when it's expensive. And he's just sold a bucket load. So at the moment, at least with cash, you're going to get 4.5, right? Now, that's not knocking it out of the ballpark, but by the same token, it's cash looks awful until you start losing money. Yeah. That's when you go, oh, man, thank God.
Well, if you look at it through our principle, which is don't lose money, and the market's really, really high, you can, sitting on it or using it, my answer to this question is map the strategy to the time frame.
Yeah, and the valuation.
So if your valuation's high and you're looking at short-term investing, there needs to be a strategy to match that. You're not going to use a long-term strategy in a really high valued situation and then get shit scared and take your money out when you've lost money.
Well, that's the problem. That's the problem with, the market goes up a lot, then you decide to go and get a mortgage.
Yep.
And you're buying at the top of the market. You're buying when the yield is at low point. And you're borrowing for 25 years, right? Even 15 years. You'd much rather be borrowing when nobody wants to buy property and the yield is 8% on a rental, right? Yep. Not 1, right? Now, just to give you an example, in the last roughly 12 months this year or so, Well One has done about 25%, right? Now, that's why I'm predominantly there, because it's a short-term strategy. It's not Well 3, which is a superannuation kind of strategy, right? Now, that's okay, but I'm not knocking out 25%, right? And the reason why is because I'm more cautious there because it's a long-term time frame. The CAPE won't tell you anything about next year. All CAPE is saying is over the next 10 years, the market will probably fall. What about the next 5? Dunno. What about the next 3? Dunno. It's not a 3 or a 5 year indicator. It's a 10-year indicator, right? And that's where you need to think about, am I investing for 10 years? Yes. Okay, well, I need to be patient. I'll take the cash. I'll just hold on to it and I'll wait for something that comes along which is really cheap and then I'll
load up.
Yeah. Mm-hmm. That's all Buffett does, right? Warren Buffett is uncanny because he buys when things, I think you said this week or last week, when there's blood in the streets, right? And he's got a heap of cash and they're going, Warren, please, give us some money. And Warren goes, okay, like he did with Bank of America, right? When they went to him in the GFC and said, please buy some. And he went, okay, I'll buy 500 million and I want a 10% guaranteed dividend. Mm-hmm. That's $50 million a year for 10 years. And he bought them, he bought warrants, I think, at something ridiculous, like $8, right? And he sold them at like 36 or something. Like he made an absolute killing.
That's incredible.
And he did that because he waited and waited and waited. And he waited through all those people go, Warren Buffett's an old bastard. He's an idiot. He doesn't know what he's doing. Exactly what they're doing now. I saw one guy the other day say, Warren Buffett should buy Bitcoin. It's like, oh, Jesus. please. He's 24-year-olds telling 94-year-olds what he should be doing with all his money. I mean, honestly, from his mother's basement, right? And like, it's just crazy. But what I'm saying is you've just got to have a little bit of faith from knowing history to say it's not going to be different.
Well, you made a good point, I think, before we started recording today's podcast, was economic history is seldom taught now, or
it's not taught.
Not at a depth, at least.
It's not taught at all. It's not a subject in a modern economics degree that I'm aware of. They don't teach you about, Adam Smith, Karl Marx, Schumpeter, Keynes, all of these famous economists who are fantastic, right? John Kenneth Galbraith, Joan Robinson. They're unbelievably insightful, but they don't teach it anymore. Right, so this is why I say kids of today, there's no idea of history.
Yeah, and it's not their fault because they're not being taught it necessarily.
Well, they're not being taught, right? And it's all, supply and demand charts and guns and butter, which is an old inside joke. But the point being, this is why I say you've got to understand history, because if you don't know where you're going. The best guide to the future is generally looking at the past.
Yeah.
And nobody's doing it. That's why I'm old, sitting there going, oh, you better be careful. Capes at 40. Oh, you old fart, get out of the way. Like, I've just made money in 6 months. What would you know? It's like, okay. Because they've only thought about life for the last 6 months.
Yeah.
Right? Not the last 6 years or 16 or 60. Right? And that's why I'm keen on teaching people history, because we've been here before. Right? Oh, how did it turn out? Not good.
Yeah.
Oh, what about the time before that?
So many
not
times good. As well, not just once.
Exactly. It's not, the sample size is not huge, but what we know is that when we get here, something goes bad and everybody rushes out the door.
Yep.
Right? The Cape might go to 45. In Japan it got to 100.
Jesus.
But Japan, after the Cape of 100, spent 30 years going nowhere. Right? Stock market's been lower than it was at the peak.
100.
I know. That's why. Well, it's the old joke. Well, it wasn't a joke. The land that the emperor had in Tokyo, which is not huge, was worth more than California.
Wow.
Right? That's what I mean. It was batshit crazy. But they didn't think it would end. Right? They justified Japan is number one. We know what to do. You Americans are finished. It's all over. Asian century, all of that stuff. Next minute, boom.
Bang. Yeah.
And the same thing's gone on with China, right? They use the same economic model. You Americans are lazy. You don't know what you're doing. We're superior in all these things. Now the market's falling in China. Now the property market's falling. Now they can't get economic growth, and now they've got too much debt, and it's exactly like Japan.
It's like falling over themselves.
Well, that's why I'm just sitting here going, well, I know how it ends up. I'm not being arrogant. It's just because I know history.
Yeah.
Right? And I know the models. And I know that there's no way out for China other than giving people huge amounts of money.
Which they won't do.
To spend, which Xi won't do. Right? He doesn't want to do that because he thinks then they'll be all like Westerners. And it's like, okay, well, stick with your model, but it looks really ugly. Go and ask the Japanese how it's gone for the last 30 years.
It makes me think. I mean, even Western society, we're no better. Like we trip ourselves up.
Yeah,
look at America.
Yeah,
our property market.
Yeah, this is what you get. This is the story we've been talking about with debt. When you load up people with debt, at some point they can't spend any more money because they're paying back debt, right? And debt is not bad, but if I go into debt to build a semiconductor factory, that's good debt, right? Because I'm going to be productive. If I borrow lots of money to buy existing properties, that's not good, right? Because it's not productive. I can buy a property at $2 million. If it's got 3 bedrooms, I can still put 3 people in.
Yeah. If
you come along and buy it at $3 million, that's fine, but you can still only put 3 people in. Yeah, you can raise the rent, yeah, sure, and do all that sort of stuff. But the fact is, it's still unproductive. But a lot of people don't see it that way because, like we talked about in the special, people don't see it as a home. They see it as an investment. right? And so they're speculating. And what I'm saying is, if you want to look at it that way, no problem. But you really want to have a look at it as an investment, then start talking about the yield. Start talking about the potential failure where you don't get a capital return.
Yeah, well, as soon as that topic comes up, it's like, oh, get stuffed.
Well, yeah, it's, like, oh, we've got immigration and it's going to keep flooding in and we got land planning problems. And as I said, okay, I don't argue against that, but it's not the whole story, right? And it's not going to go on forever.
Yeah.
Right? We can't keep growing at 2% population because we've already got a homeless problem. So if we get more and more people homeless, at some point we've got to say this has got to stop.
Mm.
That's the way it works.
Well, let's take it offshore for a second. Talk about China's EV production.
Yep.
At the minute, it's almost going to match the domestic auto demand.
It's crazy.
It's nuts.
Well, that you can click on that article, by the way, if you get the week that was. It's a really good read. I think this is the canary in the coal mine, is the global auto industry. The reason why is this. Every country wants to build their own cars because there's lots of manufacturing know-how there. It creates a lot of jobs, but it creates a lot of jobs for smart people and dumb people, right?
Yeah.
Listen, Johnny, just stand on the line and, put the tyre on, right? Okay, Rob, you just keep doing that, Johnny, right? And I'm not being rude, but that's what it's about, right? We had it down in Melbourne and Sydney, right, in our production centres. You had a whole range of people, and that it's, to knock off a factory with 20,000 workers and then say, righto, now what do we do with the 20,000 workers? You go, oh, Jesus, they all can't be baristas.
No.
You see what I mean? It's like, yeah, let's just keep that car factory going, right? So the problem we got now is China has created so much capacity that it can produce something now. Oh God, I might get this wrong, but I think it can produce something like 50 million cars. Their market is 15. I could be I'm getting these figures wrong. But what it's showing is China can produce all the cars the whole world needs.
Right. So in other words, at the minute it's producing all these cars, there's only X amount being sold in China. And there's
China can
surplus.
produce 50 million. Their local market is 15.
Yeah.
That means they've got surplus capacity of 35.
Yeah.
And what are they doing? They're exporting it.
Yeah.
Now they're crushing European markets, and the Americans have said, well, no, you're not selling them here. 100% tariff, right? Whereas the Europeans are struggling because the Europeans are saying, well, hang on, if we sort of tell the Chinese not to send the cars, they're going to say to us, well, don't send, Louis Vuitton or whatever product. So this is where you get the tit for tat problem.
Yeah.
Right. So this is the canary in the coal mine because lots of other emerging markets are saying, well, we don't want to be flooded with Chinese steel. Right. Brazil. Right. Mexico had a product. The Americans are saying to the Mexicans, no. If the Chinese build a factory in your place and you export those cars to America, we don't want them because of the data chip. So the Americans own the factory in Mexico. They own the car driving around Detroit, right? And they can tap into all the data. So this is the problem we've got. And as I said a few weeks ago, it's not like Toyota 30 years ago that sold a car that didn't have a computer chip in it, right? So Toyota sold the car and, Jacob, you want to drive it around Detroit, that's your issue. We don't know where the hell it is. Now I can tell you exactly where you are. I can tell you where you've been, right? I can probably tell you where you're going to go next week, right? That's the data. And that's what, in national security terms, that's really important.
Yep.
That's how the Americans kill politicians in other countries,
Well,
right?
it's like I jumped in the car this morning and my phone every second Saturday, it pops up saying you're going to Hani's creation.
That's right, yeah.
And every other Saturday it doesn't show up.
That's right.
It's terrifying.
I know, but that's what I mean. That's why I say when you look at that, countries will say, well, I don't want Chinese tracking us, right? I mean, people don't want Facebook tracking them, let alone the Chinese. And the Chinese are saying, well, we don't want the Brazilians tracking us, right? And that's why I say this is going to be a real problem. And it's going to be someone's going to have to make a decision to say to the Chinese, like we said to the Japanese in the 80s, listen, you guys, you got to stop manipulating your currency. You got to stop manipulating import rules. You got to stop helping all the exporters because it's killing global trade. And that's where we're at.
Well, that's with the tariff. I think you were saying a few weeks ago, they just manipulate the currency to offset the tariff.
Yeah.
Which
Trump puts a 10% tariff on. They go, okay, drop the currency 10%. Right? Or they go in through Mexico or, Canada. That's why Trump's talking about tariffs on them. Because the Chinese are trying to get in through the back door through Mexico and Vietnam and Thailand, producing cars there, sending it to America.
Okay.
Right? That's why I say to you, it's not an economic argument anymore. It's a national security issue, right? Because we've got chips in cars. That's like I say to you, the Americans can basically track you wherever you are, right? It's just crazy. But we've just been sort of like, oh, well, it's all right. And that's okay. They're not interested in Jacob Senior and Steve Moriarty, but they're really interested in where the Prime Minister's moving.
Yeah.
Where's the Israeli Prime Minister? Oh, look, there he is there. Oh, we could send a missile there.
Yeah.
That's what they do.
Or they're interested in the collective Jacob and Steves as well. Like, here's 10 million,
yeah.
and they're going to buy all this shit.
Yeah. Look at everyone, all the 30-year-old boys are buying Bitcoin. That's interesting. How do we manipulate that? How do we leverage off that?
Yeah.
Right? Because it's just chips. It's just data now.
And not Dorito corn chips.
No.
So this is bonus section. So showing basically the S&P's returns over different periods, which is why we talk a lot about what's your time frame. So from 1900 to present, it's about 7. This is real as well, right? Yeah, real return.
Yep.
7.25% from 1900 to now. Changes from 2000, 2009, 2017.
Yeah.
It's your time frame.
It's exactly. Where you start out tells you what you're going to do.
Yeah.
Right, 2009, the low, Cape of 13, you're getting 13% compound.
Yeah.
Right, doubling every 6 years. Okay. If you started in 2000, you're getting 6.2. Why? Because the Cape was at 44 and the market was batshit crazy, like it is now.
Yep.
Right? And that's what I'm saying. So you've got to look at that reference point rather than look at 2009 because they're completely different.
Yep.
It's like saying, here's a car for 20 grand, this one's for 70 grand. And saying, but they're the same car. It's like, well, hang on, that's a bit crazy. I'll buy the one that's at 20 grand then.
Yep. So just for more, this is how my brain understands it. If I was starting to get a little bit, like if I wanted to get into the market in 2000 and I had, with a 6.8 return, that's what, every 12 years I'll double my money.
Yep.
Whereas if I just sat on cash and then invested the whole lot in 2009 at a cheap Cape,
you'd be a lot richer.
I'd be a lot richer.
Absolutely.
By not doing anything for 9 years.
Yep.
So this is what we're trying to say. Like, it's okay to sit on cash in high Cape environments.
Yep. You got to wait for the fat pitch.
Yep.
You cannot do what everyone else is doing. John Templeton said, you can't get superior performance by doing what everyone else is doing. Right? That's how you get the average.
Average, yeah.
So how does Warren Buffett outperform? He buys it when things are low. That's a big blurb.
This is Buffett, right?
Yeah, that's just a blurb about how he deals with market fluctuations. This one, I just want to show what you were talking about, Jacob, right? You get huge bull markets and huge bear markets, right? And what you'll notice is the red follows the blue and the blue follows the red. Well, we've had a lot of blue. I don't count 2021, 2022 as a really serious bear market, not in secular terms.
That was
in COVID.
In theory, it's a bear market because it has to go below, 20% or whatever.
Yeah, for a bear market.
Yeah.
But again, the Cape went from, I think it was 36 to 28 or something, right? So if you ignore that and say, let's do March 2009, that's what I'm pointing out. If you invested in August 2000, after a 666% climb from 1982, you lost 60% of your money, right? You didn't lose 60% of 600.
Yeah. And that's assuming you got in here as well.
Yeah.
Well, most people would have got in over here somewhere.
So that's why I'm saying Cape here is at 29, Cape here is at 5, Cape at 44, Cape at 13, Cape at 39. Yeah. Take your pick, but sure as hell, I wouldn't like to be betting that Cape's going to go much higher.
Yeah.
right? Not after a 15-year bull market.
Yeah, and it's a really simple way to look at things.
Absolutely. I'm not complicating it by saying, "Oh, yeah, but Steve, economic growth is good," and "Oh, yeah, but Steve, the economy's really good, and we've got AI, and we've got Bitcoin, and we've got all these things really going on." Mate, just look at the numbers, right? Just look at the numbers. We've got people going crazy buying everything that moves. Best of luck.
All right. Well, if you want to know more, I'm enjoying these questions, by the way. So if you listen to the podcast and you're like, what do you mean by that? Send us a message, either email, YouTube, Instagram, whatever. We'll answer a few every week. All right.
No worries. Thanks, folks.
As always, remember, we don't provide financial advice.